Welcome to the What to Watch video update. This is the last video that I do each weekend where I go through all the charts that I've been observing over the course of the last week and talking about in the daily videos and some from the weekly videos and other videos that I do. And I put them all together and I say, okay, which charts are really saying something to us now? And then I put them in this video. We have a positive side, a negative side, and then an area that we're just watching because those other areas can often have an impact on what's happening in the S&P 500. This is being prepared for Monday, March 24th. The first area that we look at are those things that are positive. And even though it looks like things are improving, our list is still pretty short. And what I'll go through is with each chart, I'll say why I think it's positive, but at the same time, I can often pick out some negative things just to watch for at the same time. Okay, so here's the intraday chart, and it's on the positive side this week because we were up about 0.5% with the S&P by the time we closed on Friday. Going back to Monday, we had a pretty good move going into the end of the day, but then a lot of that was given back. That didn't really give us a lot of confidence. Then on Tuesday, we gapped lower. Things were weaker before the open, and that's why we gapped down. We came all the way down to this level and we just sat here. There was really no attempt to take us off of this lower level, and we just closed pretty much at this lower level. Now, Wednesday was the day that the Fed met, and we did have a higher open, and things were kind of not really moving all that much. But then this is right about the time when the Fed came out with their announcement. They didn't do anything that surprised the markets. They didn't change rates. That's what they said they were not going to do or going to do. And they're cutting back on their growth outlook and they're increasing their inflation outlook. And the way things are still coming out right now, anyway, it looks like there could be two rate cuts later in the year. And that's kind of what the market picked up on here. And we saw a nice little upward move, but then we gave some of that back going into the close. These are really weird gyration movements where you just kind of sit back and watch it happen. Then on Thursday, we actually gapped lower, but then we came up. We actually got back to just about the previous day's high, and then we started to go down. This is not showing a lot of confidence, although we did close up off of the lows. Now, Friday was quadruple witching. So we have multiple kinds of options all expiring at the same time. And that is kind of its own crazy day. It happens 4 times a year. They're quarterly occurrences. And so we just kind of watch because this day can be so crazy. It doesn't necessarily feed into what's going on. There are so many option contracts out there that if we go up or down, suddenly the status of those contracts is going to change and people have to do something. They either have to buy, they have to sell. Well, we did gap lower and then we set up kind of a base here near the low that we set back on Tuesday for the week. We were able to come up off of that and we just kind of chopped around. But at the end of the day, we saw a little spike up here, enough to get us above the unchanged level. That's the dash line. And we hit this daily pivot. And this is a line that we know about before the day even happens. And we hit resistance right there and closed just a little bit below the daily pivot. This is what put us into positive territory. We were negative overall. And internally, the market was more negative than positive for all of the day on Friday. But we did end up to squeak out a positive close. And we were up for the week. So that's why it's on this side. Now, another thing that's kind of positive, but it can be negative at the same time, is that the advanced decline line based on price and volume, they're holding up fairly well. They're above these moving averages, so they're positive. That's the good side of things, is that we're not seeing a real crumbling of these lines either based on price or volume. The negative side is we're still seeing that rotation. It's not that money's coming out of the market. We would see these really going down if money was going out of stocks into cash. We're seeing more rotation, and that's the negative side. We're still seeing this rotation from growth to value, and growth is just not showing any strength right now. That's what we need to be doing really well for the index to go back up. We need growth to outperform value. It's not doing that. But we'll look at some other charts that deal with that here in just a moment. But for the most part, this is still holding up. This just means that internally, the market is strong. It may not be strong in the way we want it to be, but it's still holding up. We're seeing an improvement here. The new highs minus the new lows. We did see a little bit of an expansion of new lows on Friday, but we're seeing more green overall than red. And so that's making our 5-day moving average go up. And we're still going up and leveling off a little bit here with the 10-day. So this is improving because we had been going down. Now we're at least trying to turn and go back up. Accumulation distribution. This is smart money indicator number one. We went up on Friday. We're above this red line, above the moving average, which is the red line. And when we're above that, it's considered to be positive. And it's even more positive since right now it's going up. Chaikin money flow had been negative. We were dropping below zero. We were below this red line. Now we haven't quite turned up with the red line yet. It's really hard to see. It is turning up. But with the upward move that we saw, we actually went back to positive with the histogram here. That's green. And we are turning up with the red line. So this is turning back to positive. And then our third smart money indicator, the Chaikin oscillator, it spiked up above the midpoint. So this is looking positive too. So for the first time in quite a while, our three smart money indicators are actually looking positive. We'll have to see if there's any more carry through on Monday because some of this could have been option expiration induced. Now we're positive with the daily chart of the parabolic SAR. We still have the dots underneath. That's positive. So that's looking good. But when we get to the negative side, the weekly chart is still negative. Now we're seeing an improvement with momentum as we've been trying to go up a little bit here. The short-term oscillators are picking that up after being really extreme with the slope oscillator and even the TSI. They've actually turned back to positive. We're showing an improvement, but we haven't quite switched over to positive in the intermediate term with the MACD, PMO, and PPO. And we really are still going down for the most part with our two long-term oscillators, the TRIX and KST. But I have this on the positive side because we need the short term to turn positive first and then followed by the intermediate term and then hopefully by the long term if we're going to switch back and look more positive. Another momentum oscillator that I don't have on the previous chart here is the Copic curve. It crossed above this red line. That has now turned positive as well. And we have long-term support for the S&P. This pivot point, this is a weekly chart, and this lasts for the whole quarter up here. And we're still above this. We fell down below it week before, but we were able to close back above it. That kept it positive a week ago. We stayed above this level for the entire week. This was about where we hit the low during the week, and we closed back above it. So for right now, this long-term support is still holding. We're also seeing some positive things here. Even though this is getting ready to generate a golden cross, this is the staples, which are defensive, to tech, that's growth, ratio. When this is going down, that means the staples are underperforming tech. Well, this is starting to go back up, but now has started to come down. We're a little bit concerned about this, but if we can keep going down, that would actually be more positive for the S&P. That means that staples are still continuing to underperform. Also, we look at another ratio of staples now to the S&P, where it looks like we spiked and we're continuing to come down. You look at other times when that happened, usually good things, at least in the short term, happened after that for the S&P. Doesn't have a perfect track record, but a pretty good one. Then we look at the advanced decline line. Now, the reason why this is positive is because of the S&P. We did decline, but we're at the moving average. Where the other indexes, the NYSE just with common stock, the mid caps and small caps, they're all below the moving average. So they're negative. But the S&P is still holding out right about at its moving average. And then the NASDAQ 100, the momentum. We're seeing just enough of an upward move right now to turn the PPO, that's this momentum oscillator, and it's starting to cross back over positive. And we look at a ratio of the NASDAQ 100, that's growth, versus the Dow, which is considered value, even though NVIDIA and Microsoft are in the Dow. And this ratio is holding up fairly well. We're still above this red line. Even though it's been coming down, we're not falling apart like we have in the past. It's still hanging in there for the most part. We also look at the NASDAQ 100, this time represented by the QQQs, which is the ETF for the NASDAQ 100. And then IWM, those are small caps. And this ratio is also holding up. Now, it's not because the Qs are doing good. It's because the small caps are doing so bad. And that's keeping this ratio kind of high for right now. But that's still positive, at least as it applies to the bigger, larger cap stocks. And we've been coming down with interest rates. I could have easily put this on the negative side, but if we can continue to fall with interest rates, that would be more positive for stocks. And a few weeks ago, we were really following interest rates when it was up at this 4.5% level and really going up. That was what was pressuring stocks at that point. Well, they seem to have stopped paying attention to that as much. And now the market's worried about tariffs and economic growth and foreign policy and things that are going on. And that's what's causing a little more concern these days. But if we do start to go back up, and especially if we get to that 45 on here, that's the 4.5% level, that's going to be more negative. So we want to keep an eye on interest rates as well. Now, the negative side, our list is quite a bit longer. We're still seeing the red line above the blue line. The red line is value, the blue line is growth. This is an intraday chart. It's 10 minutes. In really positive environments, like back here, you could even go back to the beginning of 2025 when things were looking a little stronger. The blue line was above the red line. Now we see where the blue line's below the red line. We want this to go up above the red line to show that growth is outperforming value intraday. We're seeing that same thing here with S&P growth of value on the intraday chart. We're just going sideways right now. And we look at the small caps underneath the 200-day moving average with this ratio and going sideways. That's negative. Mid cap showing a little bit more improvement. They actually were able to get above their 200-day moving average, but we're still well below the 200-day moving average with S&P growth to value. We need this to go back up and continue to go up to be more positive. And we look at a growth ETF versus a value ETF. We're still well under the rainbow. We need to get back up into the rainbow first and then try to get back above it to turn positive. Then other growth to value ratios, the Qs to S&P, discretionary to S&P, large cap growth to value. All of these are below declining moving averages. So that's negative. And we look at the large caps, the mid caps are improving a little bit. They're coming up to the moving average, but the moving average is still going down. And small caps are having some trouble now. So these are all negative on this chart as well. And we look at discretionary to staples, another form of discretionary, the things that make life fun, versus staples, toilet paper, toothpaste. We're down at the 200-day moving average. We had been doing better. We've been falling back lately. We need this to be more aggressive to the upside to be more positive. And now we look at the short-term trend. We've actually started to weaken. Now with the ADX, that's what I use here. It's the average directional movement indicator. That's the black line that you see here. And this doesn't measure direction. It measures the intensity of the trend. As this is going up, that means the trend is stronger, stronger, stronger. When this starts to roll over and cross below the moving average, now that means in the short term, the trend is starting to get weaker. As we were really coming down, the trend was strong, 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 strong. Now that we've been bouncing back up, we're starting to see this weaken a little bit. It could suggest a change. We don't know that, or at least things have slowed down a bit. It's still negative though, because we get our direction from the red line and the green line, and the red line's above the green line. So this is still a negative trend, but instead of it being a strengthening trend, now it's a weakening trend. And we're seeing just about across here with the intermediate term ADX. If it crosses below the moving average, that means a weakening trend, although it's still negative. Now, another concerning thing is this is a weekly chart, and we're just getting started with the trend here. We're above the moving average. We haven't come up to 20 yet. This is a static number, and it will be confirmed a trend once it goes above 20. But this is still getting stronger, and the red line is clearly above the green line. So longer term, the trend is still negative. And another thing, I put this on the negative side because as we've been bouncing up and going sideways here, we've seen volume really dropping off. Now, we saw a huge spike on Friday. That was due to options expiration. But for right now, anytime we've been trying to go up, and even the few down days that we had, we're seeing a drop off in volume. People are getting frustrated. They're getting confused. They're not really sure what to make of what's going on right now. And that could actually work to our advantage because when people are confused, they get out, they sell, they sit on the sidelines. And so things then might have a chance of actually doing better. Then this is another thing that's negative. It should be positive. We're down below 25 now. You can see usually when we get down to 25 or near there, This is, see, extreme fear. That's usually when we see some kind of capitulation. That's when people have thrown in the towel and said, okay, this market's never going up again. I give up. And then that's about when we hit a bottom and then we bounce up out of that. Well, we came down below 25 and we're just sitting under this level. And that's a very strange thing to have happen. The market is just consistently pessimistic. And usually that produces some kind of a bottom that we can come up out of. But until we break back above 25, I'm considering this to be negative just because this has gone on for quite a while. And then we're seeing that also in the individual investor survey that comes out weekly. For multiple weeks now, they've given extreme negative readings. Usually, when they get extreme, it's when they've thrown in the towel and they say, okay, just get me out of the market. That's where we see a real dip down. And then that usually is a bottom that we come up out of. No, they're sitting down here being pessimistic week after week lately. Now, we are showing a little bit of improvement with the VIX, but it's still negative because we're getting very high readings. Wednesday, Thursday, and Friday, we actually closed below this blue line, which is 20. When we're above 20, that's when things are quite negative. If we can stay below 20, that's when things have a chance of being more positive. If the VIX can continue to go down and drop below these moving averages, that would be positive. But this is on the negative side just because even based on what's been happening, we're still getting a very high reading with the VIX. And this line chart is just the closing value. This bar chart is the open, high, low, close. And we're negative with the vortex. The red line is above the green line. So that's clearly negative there. And we were looking positive with the bullish percent index for the S&P, but then it went down on Friday and dropped below the moving average. It's hard to see, but this has actually turned negative after spending a few days being positive. And we're below zero here with the S&P McClellan oscillator. That's negative. And when this is below zero, you can really, you have to look to see this, but we're turning down based on price. Now that's the negative side because we're going down. But if you look down at the bottom, we're still going up based on volume. So we're getting a mixed picture with this chart. Are we negative because we're going down based on price, or are we positive because we're going up based on volume? I'll let you decide that. Price is the ultimate indicator, and so that's why I chose to put this on the negative side. And we're going back down now with the Swindler Trading Oscillator. Based on price and volume, both are ticking lower. However, they're both still above zero, but they're both going down in unison, so that's negative. And this is the weekly parabolic SAR. 3 weeks now, we've had the dots on top. That's longer term negative. And this is a long-term oscillator called the Special K. We dropped below the red line. I stopped showing this in the daily videos because the last time we got a signal from this chart was the end of 2023. So it's like, okay, I'll just tell you what's happening. And then if we see some kind of a cross here, then that's when I start showing it in the videos. And we're seeing overhead resistance with anchored moving averages. This light blue area is going back to the low set about a year ago. And we've had a really difficult time getting back above this blue line. We broke below it. That was negative. And it's still negative until we can get above this blue line and go above it. That's if we go up. Now, if we go down, we have another purple anchored moving average going back to the low set in 2023, another significant low. We may go down all the way to this level. And then we could get even worse from there, but let's deal with that if it happens. But for right now, this is considered negative because we're below this light blue line. And we're below all the plotted moving averages. I plot both a simple and exponential 20, 50, 100, and 200 moving average. And we're below all of them, and we've been down here for a while now, so even the short-term moving averages are starting to roll over. Now you notice here, this lighter gold line here, this is the exponential version of the 200-day moving average. This is also providing overhead resistance. We cannot seem to get above it. Now most folks don't use an exponential moving average. It moves faster than a simple moving average because it's weighted more towards current price. But if we could get above this, that would be a good sign. Then if we could get to the 200-day simple moving average, that would be another good sign if we break through it. We could come up here and hit this resistance and turn and come down. That's what we're trying to figure out right now. If we bounce from here, are we going to get enough of a bounce to turn everything back positive and switch to a more positive climate? Or are we really in a downtrend that's just beginning now, and this is just a bounce that we're going to see counter trend to what's going to happen later where we hit one of these resistance areas and then turn and then go back down. That's what we're trying to evaluate right now. And you can make a case for either side. That's why I would really recommend watching the videos that I put out each day. I go through all these charts and we watched it happen incrementally each day. Then this is another right now acting as overhead resistance. It's a 20 period simple moving average of the open, high, low, close. It's set around the short term simple moving average, but this ends up being more of an intermediate term indicator. Now, the reason why I'm showing this is we're clearly negative here. But sometimes if we come up here, like we came up to this pink line, that's acting as overhead resistance. You can see other times when we've been going up and we fall back, it acts as support. When we've been going down and we come back up, it acts as resistance. So this could be a form of overhead resistance as well. If we can break through this, if we keep going up and get above the rainbow, that would be more positive. We're also watching Fibonacci levels from the all-time high set back in February. We did break down below the 50% level, but we've been able to get back above that. So this is support. This is about the 55.50 level to the downside, but we broke through the 61.8% retracement level here. This is at 56.91. And this is a tight range that we've been in for the last number of days. We cannot seem to break above this, nor are we breaking down below it. That's what we're waiting to see to happen. What and how long are we going to go sideways before something breaks either up or down with this chart? And then the Dow, it was the last major index to lose its 200-day moving average, at least based on the ones that I follow. It came down above this, below this green line and dropped below it. It's having a hard time getting back above it. Will it be the first index to actually get the 200-day moving average back, meaning that we'll close above it? Now, another video that I do called the deep dive video, where I look at 6 different indexes and then rank them from 0 to 100. And the Dow is looking the best right now with the S&P in second place. Now, none of these are looking good, but this is looking the best of the bad, I guess to say it that way. So we're going to be watching this. A lot of times I dismiss the Dow because it's only 30 stocks. It's not a real representation of what's going on, but it's so famous and so many people follow it. We'll be waiting to see. Can we get back above the 200-day moving average and then stay above that? That would be more positive. Right now, this is acting as overhead resistance, and that's negative. Small caps starting to generate a death cross here when we look at the S&P 600. That's one of the 2 small cap indexes that I follow, and this is clearly negative on a trending basis. But there's been other times when this has happened before, and then we see a counter trend move. We cross negative when we go positive, or we cross positive when we go negative. That's the shortcomings of working with moving averages, is that they lag. Now, we're not quite at the death cross yet, but we're really close. And we're probably not going to see a move up above these moving averages in Monday's session. So, yeah, it's looking like this is going to be a death cross for the other small cap index that I follow, the Russell 2000. So this is turning more negative as well. Mid caps, not as close to a cross, but still below the 200-day moving average and looking more negative currently. Micro caps getting really close to a death cross here. These are really small stocks on a comparison basis. If this crosses over negative, see, they were positive for all of 2024. Now we're seeing that threatened. And then total US stock ETF. This is the biggest ETF I know about anyway. We're underneath the 200-day moving average and having a hard time getting back above it. FANG index right at its 200-day moving average. These are the really big stocks, the mega caps. Semiconductors, we're seeing a death cross here. This is quite negative because if you go back to early 2023, we bottomed in October of 2022, but we saw a golden cross here in February 2023. And this is what really led the market higher, was the semiconductors doing well. And see how they fizzled out? And this is when the market started to fizzle out. Well, now that we're dropping down and looking negative, this could turn the overall market more negative. Financial sector, it's actually doing okay. The reason why it's on the negative side is we're still below the 50-day moving average, even though I've been watching this pretty closely because this might give us some clues if we're running into problems with the banks or something in the financial sector is getting ready to blow up. So we're doing okay with this chart. Where it's a bit of a concern is when we start comparing it to the KRE regional bank ETF. That's down at its 200-day moving average. And just to get more insight, we do a ratio between that regional banking ETF, the KRE, and the financial sector. Even though the financial sector is holding up well, the smaller banks are not. And so we're wondering, remember Silicon Valley Bank, Republic Bank, New York Community Bank, is some kind of bank information or news going to break and it's going to freak the market out? That's why these ratios went down in the first place. So we just want to keep an eye on this. This is a concern to us. We want to see this doing better than what it's been doing lately. This also measures stocks to bonds. And as a general rule, when we're above the rainbow, that means the market's anticipating a soft landing. That means no recession. Well, we've dropped below the rainbow now. And that means that there's at least some concern out there that we might, in fact, go into a recession. And the longer we stay below this rainbow, the more likely the market is thinking that is what will happen. Now, I'm not showing all the charts that I usually show if you've watched any of these others videos, these what to watch videos, because you'd see the same thing. All the different ratios that we look at, they're all below their rainbow right now. This is one of them. And I am showing this because this is actually more negative. This was one of the first ones to turn negative back in late 2024. Home construction versus bonds, that's when interest rates were going up and this was going down. This is not doing so well right now. And that's quite negative. And we're below this long-term trend line with the NASDAQ 100 going back to 2009. We're below it. So that's more negative. And we're going down with the semiconductors to Dow ratio, again, growth versus value in a broad sense. When this is going down, that means the semiconductors are underperforming value. We want this to go up. And then we have this thing called the Hindenburg Omen. And if you're a perma bear, you love this thing. Even if we are in the neighborhood of one of these things, you declare it as a real thing. But there are three criteria that need to be met for a Hindenburg Omen to actually be triggered. You can pause this, you can look at this and read through it if you'd like. I got this from stockcharts.com. What I want to look at and talk about is the chart itself. Basically, they've taken that three criteria that was on the previous slide and they put it into a chart that we can look at. Now, there's a 1 day lag with this chart, so we won't get Friday's data until after the close on Monday. But we did see a spike back on March 3rd. Okay, now the perma bears are partying and they think, okay, the end of the world is upon us. But according to how this indicator works, we have to see a second spike between now and March 31st. And that hasn't happened yet. We don't see another spike up. We've seen individual spikes along the way here, but we were able to recover. Are we going to be able to recover this time? Now, other times when we saw a group of spikes together, this is right before the COVID crash. Wouldn't it have been nice to get a warning like that? Then this is at the end of 2021, before we went into the bear market in 2022. So I used to dismiss this chart because it's a perma bear favorite, and I'm not a perma bear. It's like you're wrong 70% of the time because stocks go up 70% of the time. No matter what positive things are on the horizon, they always say the next crash, the next crazy thing is just around the corner. It's like evidence doesn't mean anything to them. I'm a perma realist. There are times when the market goes up and there are times when it goes down. And I teach strategies in my program that can show you how to make profits no matter what the environment we're in. So we're waiting to see if there's more spikes along the way that could be pretty significant. But so far, it has not happened. So these are some areas that we're just watching. Now, I had this on the negative side. I put it over into the watching side this week because we were really coming down. This means that fear is increasing between risky and not as risky bonds. Or to say it another way, junk bonds, which are risky, and government bonds, which are very safe. Now, when we're getting a very high reading here, that means there's not much fear in the bond market. When this starts to come down, that means fear is increasing. This is an inverted chart. It's inverted. In fact, down here is an inverted version of the VIX. We want this to go back up for things to turn more positive. If it keeps falling, that's going to be more negative. We want to keep an eye on jobless claims. And so far, they've been holding up fairly well. And this is what we're going to be watching to see if we go into a recession. Is employment falling apart? Not yet. But we watch this every week. We watch the employment data as it comes out, and then we really key into the employment situation report that we get once a month. So far, that's been holding up. Now, is that going to change at some point? We might get some clues by watching this to see how this is going. Now, the moving average is still going up, but we're not really breaking out to the upside here with people becoming unemployed for the first time. We also keep an eye on continuing claims. These are longer term unemployed folks, and the moving average is going up, but we're still well within the range that we've been in for quite some time now. The mass index, this is a three criteria signal. And the first one is when we cross above the red dash line, then above the blue line. The third one will be when we come back down below the red dash line. We don't know what's going to happen. And then the way I look at this is once the signal is triggered, the longer we go and the signal that it's trying to tell us doesn't happen, the more irrelevant the signal becomes. So we're waiting to see if this really does fall and are we going to get a reversal? Now, what brought us to this point is that we were going down. That produced this signal, set of signals. Is this signaling that we may go up from here? We don't know that yet, and it may not even be relevant. There's another chart that we're looking at called the Pring Bottom Fisher. Its signal has gone away. It's not even near a signal now, where a week ago it was. And we want to look at the performance of bonds versus stocks or stocks versus bonds. This has been going down for a long time here. That means the bonds are underperforming stocks, and that means stocks are outperforming, and that's more positive. But you can see how we've really been coming up lately. This is a concern that we want to keep an eye on. And then we look at this because a lot of people are talking about inflation. It's like inflation is, well, what is the market saying about inflation? We can look at some charts as kind of a proxy way of trying to figure out what is the market saying about inflation. Well, first of all, we look at cash, which is represented by the 1 to 3 month T-bill. You don't really get a return on that, so you might as well carry it around in your pocket. And then we compare that to 3 to 7 year bonds. A little further out, you get a higher interest rate for that. When this is going up, like it was in the fall, that means folks are worried about interest rates going up, and they were at that time. They're worried about inflation, and they were at that time. Well, folks are talking about inflation now, but look at what this ratio is doing. We're actually going down here. Now, we're still in an uptrend, and that's one of the lagging features of a moving average. But this has been coming down, which is more positive. This chart suggests that the market's not all that worried about inflation. Let's see if we can find that same thing in other charts. Tips, Treasury inflation protected securities. This is what folks get into when they're worried about inflation and interest rates. They adjust for interest rates. So you can get into one of these, and then if inflation and interest rates keep going up, you'll get adjusted to the higher rate. Well, that's what people are getting into back at the beginning of 2024, and that was causing a concern. Well, what's happening now? Right at the beginning of the year, this was going up, and that was causing us some concern. But see how it's leveling off and now actually coming down? That shows that inflation concerns are actually going away, not increasing, according to this chart. Now let's look at the same thing, tips, and then let's look at further out bonds. This looks at 7 to 10 year bonds. It was really going up, and that was causing some concern. Now it's coming down. Okay, so we're seeing kind of a story being told here. We want to keep an eye on the different yield curves. Now, the 10 to the 2 year, which is what most people follow, it's above this blue line, meaning it's not inverted. The 10 year is above the 2 year as far as the yield. It's when they go over each other, when the 2 year is actually giving you a better return than the 10 year, that's when they go inverted. But this chart looks okay. This one does not. This is the 10 year to the 3 month. Other people use this, and we're actually going inverted now. Not very much, but inverted is inverted. Okay, so we're into this red area. This could be a sign of economic problems. Now, we went inverted back in 2022, and we stayed there for a couple of years, and we finally went uninverted. We didn't go into a recession during that time. So it doesn't necessarily mean we're going to have a recession, but the fact that this was coming up out of being inverted and now it's gone back down, that's showing some concern in the market. So we'll keep watching this. And then because Germany's just flying to the moon these days, and Stocks in the US are going down. You can see how the German DAX is going up. We're seeing a real drop off here in the correlation between US stocks and European stocks. They're really outperforming right now. Now, what's likely to happen is people are going to see something like this and go, I'm taking my money out of the US. I'm going to put it into European stocks. That's just about the time the party's over. So if you've waited this long to do something like that, it might be too late. You might get a little bit left. It's like if you arrive before midnight, there's still some of the party left. So we'll see. But this is just strange. Usually the US and Europe move more in correlation with each other. That's why we see high readings down here. They might be going up or down, but they usually move together. This shows they're actually having a tendency to move in opposite directions. And we want to keep an eye on oil, which this is not inflationary. It's actually been going down. We got back up into the 70s and we dropped back into the upper 60s now. We just want to keep an eye on this one. And we also want to keep an eye on the dollar. Really doing well here in late 2024. We get into 2025, it just went down the toilet and it's really been underperforming other currencies, and we're below the 200-day moving average. Now, this is actually positive for stocks. They like a weaker dollar because it's better for the exchange rate, it's better for import-export relationships. But the reason this was going up is tariffs, 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 Trump. Oh, no, 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 no. And now it seems to be really cooling off. Now, we've got another day coming up here, April 2nd, which is when a lot of these tariffs are supposed to kick in. We'll have to see how's the market going to react to that? How's the dollar going to react to that? So just another thing to keep in the back of your mind. So thank you. I really hope you found this helpful. Have a great weekend, and I will talk to you in the next video.